Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, January 28th, 5:08 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the Big Show, a Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at the key levels for next week, and update. Yes, it's back, the world famous 21 over 21 leaders list. Let's get right into it. State of the market. We continue to be in a correction since January 18th. Today was day 5 off the bottom of a rally. You know, we look for rallies on higher volume with significant strength, preferably 4 to 7 days off the bottom for our re-entry signal into the market. Well, we got the price action, but we didn't get the volume action, as volume was just about average and below Thursday's volume. So not a confirmed follow-through day. And also missing from today was the confirmation of leadership breaking out of sound bases, stocks jumping up and say, hey, look at me, I'm moving higher on big volume. I'm a market leader. You want to own me? There really aren't too many of them. We do have a 21-21 leaders list, but sparse is the word for institutional quality leadership stocks that are on that list. And we'll go through that in a minute. So let's check over here on the trend gauge. Market leaders were still showing bearish since 1.7. Short term, we're well below the 21-day short term exponential moving average across all 5 indexes. Same thing on our medium term 50-day moving average. Long term, staying on neutral. Second weekly close under the 200, but it was a higher close versus last week. I've got some intricate rules that dictate when I move these arrows, and the fact that we closed higher versus last week shows a lack of weakness, not necessarily strength, but a lack of weakness. So we're staying on neutral from a long-term perspective, and then we'll see what next week brings. So let's dive into what happened today. As I said, big rally, but light volume. The G5, actually G6, what am I doing? Our leaders list up 2.66%. That's pretty good. Growth very much led value today. So that's a little bit of a risk on perspective on the market today, but it's not unexpected because we really have sold off so hard, so far down. And today is kind of typical of what you would consider a short covering rally in the market, especially with the lack of leadership stocks and the lack of volume. But price is price. S&P 500 up 2.4%, NASDAQ 100 up 3.1%, Dow Jones up 1.7%, mid-caps up 1.9%, Russell up 1.9%. A diversified worldwide 60-40 stock and bond portfolio up 1.01%. Our flagship portfolio, GROTECTION, negative on the day. We're still defensive. I've explained why several times. I'll show the stats here in a little bit too, but we're still under the 200-day moving average. Lack of leadership stocks. We play it light when we're under the 200-day moving average. That's when risk is at its highest. So let's get to the tail of the tape and then the 21-21 list. But first, let's check out the team here at Revere. Our mission is to grow our clients' portfolios in uptrends when the market is cooperating and protect them in sideways or downtrending markets, such as we've been in all of January. This is one of the worst Januaries on record. We were down 9% coming into today. Now we're down 7%. That's a pretty big 1 month hit. In-house, we've got a significant edge on the market year to date, and we plan to keep it. And that's because of the protective action that we took while risk picked up in the market. And if you're interested in this approach, give any of us a shout. You can email Dan, Tim, Hunter, Mural, Alex, or Don at revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. First of all, let's bring up the bear market stats. I showed this last week. I want to show it again. So this is why we take such specific action protecting our client accounts when we're under the 200-day moving average on a daily chart or the 40-week moving average on a weekly chart. These are the numbers from the last 12 bear markets. On average, top to bottom, a 33.5% decline. From the top until you hit our exit signal, which is a close of 1% or more below the 40-week or the 200-day moving average. Normally you lose 11.3%. I'm okay with losing that off the top. Our portfolio is actually down about 9% off the top. I'm not okay with losing 33.5% though. So just going off the index is 11.3% down until you exit. This stat, re-entry, 1% below. This is where we pull the trigger here. Okay, 11.3%, and then all the way down. This is the pain avoided before we would get our re-entry signal, or before we would reach the bottom. An additional 23%. So 11.3%, I'm okay with that. 33.5%, I'm not okay with that. This 23% is what we avoid if a full bear market comes, and we got out of the way as soon as we broke the 200-day moving average. So that's the way we play things here. That's the way we've been playing it, especially last week. We got our first close below the 200-day moving average. Let's go now to the S&P 500. You can see this big black line. Let me blow this up a little bit. This big black line is the 200-day moving average. This is where risk picks up when we're underneath here. Look at a monthly chart of the indexes. It's the equivalent of, well, let's look at a weekly chart. It's the equivalent of this black line here also, and you can see how we broke below it in December 2018. For COVID, we broke below it. We broke below it again. Monthly, you can see the big corrections. The 2000 bursting of the tech bubble is actually scrolled off. The financial crisis hasn't. It's very similar to breaking below these moving averages, and that's when we want to get out of the way. So step one, when you're in a hole, stop digging. And let's take a look bar by bar here at what we saw this week. Let me bring it up on a 30-minute chart here. So here's the big gap down. This was Monday, but we finished at the top of the range. So very often you see that. You can see how harsh we fell coming down into the end of last week. Big gap down on Monday, but we finished at the top of the range. So last week we got our first close below. Ugly day on Monday, but that's put in the bottom so far. The last 4 days, and this is a testament to the bulls, we have not broken below that. We've kind of traded in this range from 44.30-ish down to about 4,300. But we're not going any lower. As you can see how 4,300 has acted as support. And the bulls are just simply not giving up, no matter how much inflation is being thrown at the market, no matter how much debt is being thrown at the market as far as our national deficit, no matter how bearish some of the news is with shutdowns and economic slowdowns and slowing to reopen after Omicron. The market just hasn't surrendered, and that's a testament to the strength of it. We respect the risk when we're under the 200-day moving average. We get back above it. We've got rules for re-entering the market, and those will kick in if we get the follow-through day and the proper leadership from the market. So there's your S&P 500, 2 weekly closes below the 40-week, aka the 200-day moving average. This is where risk is. We're respecting that risk and playing it light. But like I said, we've got a plan. We'll get back in if our get back in rules kick in. Also want to note this purple line down here. The first step to recovery on this is going to be closes in the indexes and leading stocks above this 8-day exponential moving average. This is our ultra short-term indicator. You can see how any rally has been thwarted by the 8-day, including today on the NASDAQ. This is just one of the signs that we're looking for to re-enter the market. Let's go to the S&P 500. We got just a tick of a close above 0.1% above the 80 MA, and And look at this this intraday chart. When we were filming the podcast, we were back here around noontime. And then we started selling off afterwards, and it looked like we were going to revisit the lows of the last couple of days. But the last 2 hours were just an absolute from 43.30 to 44.30. 100 S&P points, that's about 2.5%. Huge rally into the close. This is what you see in bear markets. And basically, there's some of the crowd will say, well, anybody that was short or betting that the market goes down was wanting to cash their chips in for the week and get out of the way before the weekend comes. Maybe, maybe not. Again, volume was light. The volume wasn't there that we wanted to see, and the leadership stocks aren't there also, but we still respect the price. So we're right back up to below this key black line, the 200-day moving average. We get back above it next week and see some good participation in leading stocks. We'll start dipping more toes back into the market. Let's check the Dow Jones Industrial Average, index number 3. Same thing, closed above the 8 now for the first time, still below the 200. That's the black line. The faint purple line is the 8. The black line is the 200. So all of the moving average is still below the 200-day moving average. The closest to getting back above is the S&P 500, and the S&P is where all the rotation within the market takes place between growth and value and between sectors. So here's mid-cap stocks undercut. They did undercut their lows from Monday. So this weaker than the big cap indexes, but did close back above it, still below the ADMA. Here's small cap stocks. Also undercut today, but closed back above it, still below the ADMA. Now let's look at the components of the G6. This is our growth, our proprietary in-house growth index that we use to track the strength of the market, and this still looks absolutely terrible. I should say the strength of growth stocks. Note the purple line, the ADMA declining. We're still well below it. The first step, again, that we want to see for getting back into the market is some strength in smaller and mid-cap growth stocks, giving us the confidence to start getting back in. So that's what we're going to be looking for. IWO is the first ETF, FFTY. The second one, below the ADMA. And here's the 200, here's the 50, here's the 21, here's the 8. This is why we got out back up here and protected our clients from all of this downside here. The hole that we fish in, small and mid-cap growth stocks, the hole's dry right now. And we're waiting for it to be restocked, and it's just price action that we'll be looking for and the proper setups, and we'll jump on them if and when they're there. QQQJ, the third component of it, same situation, below the declining 8 EMA. PDP, number 4, below the 8 EMA. The beleaguered Cathie Wood ETF, below the ADMA, continuing to take a beating. And the 6th component, MDYG, this is mid-cap growth, still below it, undercut, but did reclaim. So that's what we're looking for on G6, is some strength there. In the individual, this will point us, this will say, yeah, we're, the yellow light is turning more towards green. Take a look at the individual stocks. And those individual stocks are what's in our 21 over 21 list. So let's get that up. And this is the primary list, not the only list, but the primary list that we're going to be looking at for leadership. Let me show the whole list here. We've got 12 sectors, 21 industry groups, dominated by energy and oil stocks, but they're not all in the same group. There's like 6 or 7 subgroups of energy. I didn't repeat one of the groups. There's 21 different groups in here. But let's just start at the top. These are sorted by 3-month relative strength. So that means that the strongest of the stocks are going to be at the top, the strongest stocks over the last 3 months. If it's flagged, we own it in-house. So let's start off with Devon Energy. We've owned this for bought this late last week. Actually, no, we bought it on Monday when it came up through the 50 and the 21 after this 3-day shakeout. made new highs, consolidating nicely since then. We've got about a 10% gain on this. Next up is ZIM. This is transportation shipping, a leader. 3 straight up days, probing toward new highs. If you're near new highs in a market that's been as decimated as this, you're certainly a leadership caliber stock. Schlumberger, this is another oil stock, but this is a services stock. Already reported earnings, bounced off the 21. Nice reaction to that. Halliburton also could be on the list here. They make up like 44% of the OIH, Oil Services ETF. Apache, this is an international explorer, bounced off the 50-day moving average, 3 days up, consolidating over the last 2 days. Vertex, reported earnings. This is a pharmaceutical biotech stock. They have a lock on the cystic fibrosis market. There is another company that's trying to come out with a cystic fibrosis drug, so that's a little bit of caution here. But this has very clearly been bought since their earnings report. You can see by the volume, 57% above average volume today. Not too many non-oil charts look like this. LMT, after the positive reaction to their earnings report, coming up to the top of this base, you can see the relative strength evident and the price action evident also, while we've got Ukraine-Russia tensions going on. Aerospace defense stocks have acted pretty well. Archer Daniel Midland, agriculture and oil stocks and commodities have been outperforming. This is a food and grain stock, but they provide services to agricultural commodities. And you can see the good reaction to their earnings, bounced off the 50-day moving average. When you move on earnings and then make a higher high the next day, that's a very good sign. This is what you would consider to be normally a defensive stock, but money very clearly flowed into it the last 3 days. Arch Coal Energy, the move toward green energy has left a lack of carbon-based fuels, enough to go around to keep people warm this freezing winter. That's why coal and oil have been doing so well. Nice little handle being put in here on Arch Coal. AbbVie, one of the best looking pharmaceutical stocks. You can see this shakeout and move off the 50-day moving average over the last couple of days. Corning, very good reaction, gapped up, but closed at the bottom of the range on its first day when it reported earnings. I read the earnings report, or I read a report on the earnings report. They said they've got extreme pricing power. They're raising prices. Their customers aren't blinking because they need them in this fiber optic and LCD. They make glass for fiber optics and LCDs, and it's growing so fast that they've got pricing power and people need their products. So 3 days up after an earnings report always gets my attention. So Corning has my attention. MPC, another oil. This is a refiner. Pulled back below the 21, back above, bounced off the 21 today. Earnings next week, though. CF, this is another one that we own in-house. We also bought this on Monday. One of the leading chemical agricultural fertilizer stocks. Nice move up off the 50-day moving average, consolidating over the last couple of days. Berkshire Hathaway, one of the leading financials, bounced off the 50-day moving average, back above the 21 today. John Deere, earnings in 3 weeks, undercut but reclaimed the 50 and the 200-day moving average, undercut and reclaimed the 21 today. This is a nice flat base that it's forming. LNG, transportation pipeline, undercut the 50, rallied higher, nice flat base that it's forming as well. STX Seagate, big gap up on earnings. This is in the computer data storage. This was recently a leading group led by Micron until the most recent correction, but their earnings report was very well received. Closed at the bottom of the range, but reclaimed the 50 and the 21 today. If this is going to work, it'll hold today's low. Mastercard and Visa both reported today and were up respectively 10, 11, and 9%. So these had been consolidating for a long time while a lot of money flowed into alternative financial stocks like Upstart. But these reported earnings, good growth on the earnings, good report out of both of them, and getting back up toward the top of this base. These are very strong, stalwart companies that have based for a long time. Based meaning just gone sideways for months, not shown any relative strength, but they're starting to show relative strength. Let's see if they can follow up to today's reaction to their earnings reports. Booking, a pure reopen play, undercut reclaimed, the key moving averages above the 21 today. Expedia is also another option, but look at the growth here. It's got a high PE 80, but reopening after COVID, growing earnings by 825% this last year and 128% this year, getting back to its pre-COVID numbers. Apple, this is the story of the day. Fantastic earnings report, closed very strongly on well above average volume, 65% above average volume, reclaimed its 21 and its 50-day moving average. This is the key stock that I'm looking at to see the strength of the overall market. If Apple continues higher, there's a good chance it can pull the rest of the market with it. But we do want to see how Google and Amazon react to their earnings reports next week. Juniper, networking was one of the leading groups before this last 2-week sell-off. Big bounce back up today after its earnings report, reclaiming the key moving averages. Let's see if this can hold this gain and continue higher. And finally, Dutch Brothers. This has a lot of overhead supply on the left side of the chart. But if you look closely, look at the 5 days this week. It undercut the most recent lows, shook out the last of the weak hands, and closed at the top of its range on Monday. On Tuesday, followed through back to the upside. Then the last 2 days consolidated on lower volume than Monday and Tuesday. These are very good volume patterns. I've got alerts set here. They've got fantastic growth numbers, and as a reopen play and as a retail play, I like this a lot. Very strong fundamentals, and this could be a leader. If the price acts correctly, we'll be there participating in it. If it doesn't, we won't. It's that simple. And that's your updated 21 over 21 list. So to summarize where we are, S&P 500 held the lows of Monday each of the last couple of days, even though sell-offs were tried. Buyers, however, unable to get back above the 200-day moving average. So a big battle going on here between the 4,300 and 4,430 levels, with basically today's range. We're watching next week for who wins. Can we get a sustained move back above this 200-day moving average, back above this 4,450 level? And then what happens when we run into the declining 21-day moving average in the 4,500 level? You can see over here 4,500 is a key level. We could very easily fail there, but we've got plans regardless of what happens as far as getting back into the market, cutting losses if things reverse. And we've got a pretty good leaders list there that I just reviewed for some stocks that are acting well, firming up the right sides of their bases, and we want to see more joining it. But for now, I must commend the bulls. It looked like we were going to fall apart around 2 o'clock today. Strong rally the last 2 hours. Was it short covering? Was it people actually wanting to get back into the market? We're going to see what cards are dealt by the market next week and make our decisions accordingly. And that's going to wrap it. So as always, love feedback from you. I'm on my email is don@revereasset.com, or you can call 855-REAL-WEALTH. But here's wrapping up the week ending January 28th. One trading day left in January. Tough month for stocks. Relatively smooth month for our clients in-house as we recognize the weakness, got out of the way, and have stayed defensive while we're under this key 200-day moving average. But we're open to all outcomes, flowing like water, as Bruce Lee would say. So wrapping up the week ending January 28th, this is Don Vandenbord telling it like it is. Thanks for listening, and have a great weekend.